something feels off. Not dramatic, not loud, just different. You go to the grocery store, prices are still high. You check your bank app, the balance is there. Your paycheck hits, right on time. So why does everything feel tighter? Because the change happening right now isn't about losing money. It's about how easily you can use it. And this isn't a theory. Even the Federal Reserve has been saying again and again that financial conditions are tightening, not crashing, tightening. Banks are being more careful. Transfers take longer. Approvals need more steps. Holds feel more common. The Wall Street Journal recently pointed out that households are relying more on credit just to maintain the same lifestyle. Not upgrades, not luxury, just normal life. And when credit use goes up while access slows down, that pressure lands right on the middle class. According to Bank of America consumer data, Americans are still spending, but savings buffers are shrinking. That means less room for delays, less room for mistakes, less room for surprises. This is how a silent freeze works. No announcement, no warning letter, no single rule you can point at. Just small changes, stacked on top of each other. The U.S. Treasury talks about stability. The Federal Reserve talks about controlling inflation. The media talks about markets going up. But nobody explains what happens when everyday Americans need access to their money. Now, not later. When a delay matters, when timing matters, when rules you never paid attention to suddenly matter. That's why this feels confusing, and that confusion isn't accidental, because when money still exists, but doesn't move the way it used to, people don't panic, they just adjust. Quietly, painfully, and by the time it's obvious, it's already normal. This video isn't about fear, it's about awareness, because the silent freeze on middle-class money isn't coming. It has already started. You keep hearing people say, nothing has changed. The system is fine. The economy is strong. And on paper, that sounds true. Your bank app still opens. Your balance still shows up. Your card still works at the gas station. So what's the problem? The problem is movement. Money today doesn't disappear. It slows. It waits. It gets checked. It gets reviewed. The Federal Reserve calls this tight financial conditions. That's their language. But for regular Americans, it feels like delays, holds, extra steps. You transfer money. It takes longer. You move savings. There's a review. You need cash fast. Suddenly there are limits. This isn't random. Large U.S. banks have already said they're being more cautious. The Wall Street Journal has reported that banks are tightening access while consumers are leaning more on credit just to stay even. Not luxury spending, not vacations, groceries, rent, insurance, normal life. And when access slows, while bills stay fast, pressure builds. The Bank of America has shown that checking balances are shrinking for many middle-income households. That means timing matters more than ever. A delay that didn't hurt 5 years ago hurts now. This is where people get confused. They think a freeze means you can't touch your money. No. A modern freeze means you can touch it, just not when you need it most. And that's the dangerous part. Because there's no headline for this, no breaking news alert, no official warning. Even the U.S. Treasury talks about stability, while everyday rules quietly stack up. More verification, more compliance, more waiting. Each rule alone feels harmless. Together, they change behavior. People stop moving money. They stop adjusting early. They wait. And waiting in a tight system is how control slips away. This isn't about panic. It's about understanding the environment you're already living in. Because when access becomes slower than life, the freeze has already begun. This never hits everyone at the same time. It never does. People with excess money don't notice delays. They don't notice extra rules. They don't notice waiting, because their money isn't tied to timing. Middle-class money is different. It's scheduled. It's planned. It's already spoken for. Mortgage on the first. Rent due every month. Car payment. Insurance. Groceries. School. Gas. Life doesn't wait. So when access slows even a little, the pressure lands here first. The Federal Reserve keeps saying higher rates and tighter conditions are meant to cool demand. But cooling demand sounds very different when you're cooling groceries, or rent, or medical bills. That's not excess spending, that's survival spending. This is why the middle class feels squeezed even when headlines say, strong economy. According to consumer data discussed by Bank of America, many households are still spending, but the cushion is thinner. Savings don't last as long. Mistakes cost more. So timing becomes everything. A delay that once felt annoying now feels dangerous. And this is where the silent freeze becomes personal. You don't lose money. You lose flexibility. You can't move things around like you used to. You can't adjust fast. You can't absorb surprises. The Wall Street Journal has pointed out that more Americans are using credit just to maintain the same standard of living. Not upgrades, not extras, just normal. Credit fills the gap, but only temporarily. And when access tightens at the same time, credit use rises. The middle class gets pinned in the middle. Too much money to qualify for help. Not enough freedom to move easily. That's the trap. And it doesn't show up on charts. It shows up at home. When you delay a repair. When you put off a decision. When you wait one more paycheck. When you hope nothing unexpected happens this month. This is how the pressure builds quietly. No sirens, no crash. Just constant tension. And once people get used to that tension, it becomes normal. That's why this phase is so important, because the middle class doesn't collapse loudly. It adjusts slowly. And by the time the strain is obvious, the system has already moved on. This is why understanding the silent freeze early matters. Not to panic, not to run, but to stop being surprised. For years, Americans were told one simple thing: save for retirement, and you'll be okay. Work hard, contribute, wait. And for a long time, that promise felt solid. But now, retirement money doesn't feel like peace anymore. It feels conditional. You still see the numbers. Your 401k still has a balance. Your statement still arrives. So again, what changed? Access, timing, rules. The Federal Reserve keeps talking about keeping rates higher for longer, and that affects more than mortgages. It affects when people feel safe to withdraw, when they feel forced to wait, when they feel stuck watching markets they can't control. And the U.S. Treasury keeps reminding Americans about required withdrawals, ages, penalties, tax timing. That means retirement money is no longer just your money. It's money with a schedule, money with rules, money that reacts to policy. This is where stress quietly grows, because real life doesn't follow retirement charts. Medical bills don't wait. Family emergencies don't wait. Inflation doesn't wait. But retirement accounts do. The Wall Street Journal has reported that more near retirees are worried about pulling money at the wrong time, but also worried about not pulling it when they need it. That's a terrible position to be in. Wait too long, and rules tighten. Move too early, and penalties bite. So people freeze, not because they're careless, but because the system made every move feel risky. And when millions of Americans hesitate at the same time, that hesitation becomes part of the system. This is another layer of the silent freeze. Not a lock, not a seizure, just pressure. Pressure to delay, pressure to comply, pressure to hope nothing goes wrong. The Bank of America has shown that many older Americans are keeping higher balances in checking, not because they're confident, but because they're uncertain. Uncertainty changes behavior. People stop adjusting. They stop repositioning. They stop acting early. And when people stop acting early, they're forced to act late. That's when the system feels harsh. This is why retirement feels heavier now, not smaller, just heavier, because it carries rules, timing, and pressure that didn't exist the same way before. And when money carries pressure, it stops feeling like freedom. If this all feels hard to explain, that's not a coincidence. The system didn't become confusing by accident. It became confusing because confusion slows people down. When rules were simple, people reacted fast. They adjusted. They moved early. Now everything is layered. One update here, one clarification there, one exception buried in fine print. The Federal Reserve releases statements that sound calm, measured, technical. The U.S. Treasury releases guidance that sounds stable, organized, reassuring. But for regular Americans, the experience feels messy. You hear one thing on the news, another thing from your bank, something different from your tax software, and none of it feels urgent enough until it suddenly is. The Wall Street Journal has explained how financial rules today don't shock people. They overwhelm them. Too much information, too many terms, too many moving parts. So people stop asking questions. They assume someone else understands this.